Welcome back everyone, this is the Pillow channel and today we'll be explaining what dividends are, so grab your pillow, watch and relax. Before we start, we need to know what is the concept of dividends. Dividends are the way in which a public company that is listed on the stock exchange distributes a part of the benefits obtained from its business to the owners, so anyone who owns at least one share in this company will get some of these dividends. Let's see how this works with an example. John has a company that he managed to raise for several years and made the decision to go public. So he sold 10,000 shares at a price of $10 each in exchange for 10% of the company. If you are not familiar with the public concept, I recommend you to watch a video titled What the Stock Market Is on my channel, where I explain this better. Now, the end of the year arrived, and John makes the annual balance of the company, where he calculates how much he managed to gain in sales, subtracted from how much it cost him to obtain those. So he reaches a positive amount of money. This amount is what is known as a company profit. When a company is public, it can make the decision to reward its shareholders by giving them a part of the profits. This part is delivered to each shareholder in what we call dividends. Now that we know what dividends are, let's go a little further. There are companies that do not give anything in dividends, even if they are profitable. This is not good or bad, because everything depends on the plans of each company. For example, companies that decide not to pay dividends for the most part is because they invest most of the profits in growing the business. So it is a good thing, because if this reinvestment goes well, the company will be more worth and therefore the price of shares will increase. Now let's talk about a company which pays dividends. Generally, companies do not distribute the total of their profits in form of dividends. For this, the parameter called payout ratio is used. This says what percentage of the profits are distributed among the shareholders. A low percentage means that the company is reinvesting a big amount of the profits back into the business. And a high percentage means that the company is giving almost all of its profits to its shareholders, because it may not need as much investment to grow. It all depends on the business model. Another aspect to keep in mind is that dividends can be paid out to shareholders on different ways, like yearly, quarterly, and monthly basis, or even on a special day in which the company has obtained a large amount of capital. Dividends are generally paid quarterly, so every 3 months each shareholder receives an amount of money for owning the shares. Did you know there is a date where it says which date you can buy a share to receive dividends? This one is known as the ex-dividend date. Let's see an example to understand it. The company ABCD will pay dividends on January 4. So, on that day, all shareholders will receive the amount that the company agrees to give. But to prevent people from buying shares a day before just to collect dividends and sell this stock immediately afterward, the company decides that the last day in which you can buy a share to collect dividends is January 1st. This day is named ex-dividend day, as I said before. So if you want to receive dividend, you have to buy the share before January 1st. When dividends are paid, the share price falls by the same amount of dividend that was paid. This is simple. ABCD company announced that it will deliver $1 of dividends per share on January 4. So what happened is that the shares of ABCD were, for example, at $10, but now falls by $1 when every shareholder receives the dividend. And this falls in the share price is because the dividend money comes out from the company account, so the company decreases its value. What usually happens in the following day is that the share recovers to the price this one had, and the shareholders have their share at the price that was or higher, and also with $1 of dividend in their pocket. Another way a company can pay dividends is in the form of shares, and when it doesn't pay dividends, what it does often is buying shares of the same company, which can bring a great opportunity for this one. In future videos, we will be able to dig deeper into dividends on topics such as dividend tax and other forms of dividend payment. That's all for today. If this video was useful to you, please subscribe, comment, leave a like, and remember to activate the bell. See you in the next video.